You're actually looking at the notes. We've got so many comments today from Joe Stiglitz, Michael Spence, SocGen, UBS, Citigroup, all downgrading their forecast. Stiglitz saying, in fact, a recession in the US is very high, chances of at least, and of course Michael Spence, 50% chance. You're less bearish, as it were.
Well, my colleagues on the economics side put out a note recently saying dangerously close to recession, and certainly we've downgraded our GDP forecast as well. We put the probability in the US around 30%, but much higher in Europe, around 50% in Europe.
What would you like? Go ahead, John. I'm just wondering, with Jackson Hole, what are you expecting then? How will that change the dynamics, the picture?
We don't expect very much, not least because the Fed's just done something quite big, i.e. pretty well pre-commit to zero rates till the middle of 2013, and that actually provoked some dissent within the Fed board. So we're not expecting much. There might be a little bit around duration extension of the portfolio, maybe something in terms of buying other assets beyond what they've done so far, but we don't actually think it's going to be a major expansion into a QE3 type of program.
The interesting call is obviously where do you put your money in this time of uncertainty. What you're doing, you can argue it's risky, is you're raising your equity weighting to the highest it's been since April of 2009.
Yeah, that's within Asia and emerging market equities. We think that that's basically a resumption of the trend outperformance we've seen over the last 10 to 15 years. At the same time, we've downgraded our European equities exposure. So we're actually expecting a period of pronounced decoupling again, such as we saw between the end of 2008 and the end of 2009. Where the superior fundamentals in this part of the world are still growing about 6% reassert themselves, and the markets in this part of the world structurally outperform Europe in particular.
Why aren't we already seeing decoupling? I mean, people talk about the fundamentals in Asia being solid, being strong, yet we're still tracking the US and Europe.
Well, actually, if you look at the performance, particularly of the China market, China A shares relative to, say, Euro stocks, that's outperformed 15% since the end of June, which is the same kind of pattern we saw at the back end of 2008. It will be China that's the key to the turning of this trade. And certainly up until then, Asia and EM had a poor first half, and that was in line with the call we were making then as it combated inflation and it went into the year on a relatively high multiple. But now we're on one of the lowest multiples we've ever seen for Asia and EM equities. And some markets like Korea, for example, are trading where they were in valuations at the end of 2008. And that sets us up, we think, for a very big rally as the fundamentals reassert themselves.
SocGen this morning said that financial stocks in China will rally. This after the 5 banks I mentioned before just now posted this profit of the same as Goldman Sachs market valuation.
Record profit.
Pretty huge profits again for 5 banks, beating 13 European and US banks. I mean, would you agree with SocGen that Chinese financials, even though there's talk about debt amongst them,
yes,
are going to go up?
Well, we are overweight Chinese banks, Chinese financials. They're trading on forward price to books of between 1.3 and 1.5, which is at Q109 levels. They offer dividend yields of 5 to 6% in an appreciating currency environment. There are obviously questions over local government financing debt and have been all year, but the level of disclosure improved somewhat in the first half numbers in that regard. And I think we'd be comfortable to recommend them as a core part of this overweight Asia EM portfolio.
Why aren't you that concerned about the debt issue? Some people say don't touch Chinese banks simply because of the debt issue.
I remember you asking me that last time I was here. All countries have debt. All countries have central government debt and local government debt. The disclosure we're now seeing on these banks suggests 80 to 90% of that debt is covered by cash flows, i.e. these are projects that generate some kind of a return. The market's been more sceptical about that. But just debt in and of itself is not a problem. And China's aggregate indebtedness, we reckon, across all segments is probably about 180% of GDP across the entire economy, and yet the GDP is growing about 10% real and 14–15% nominal. And that's a huge difference with Europe, where the debt ratios are much higher and there's no underlying growth.
I want to pick up on China, where we left off. You talked about how maybe the debt issue will not be such a huge problem. How about inflation? With inflation, with slowing growth, that will eat into profit margins.
Well, we were very concerned about this at the start of the year, particularly on that margin point, and that's why we were cautious on the markets until the mid-year point. But we're now forecasting inflation to fall quite quickly back through towards the end of the year. I certainly think with the moderation that we're seeing in oil and base metals prices, we're likely to see that PPI inflation come off. And that, to some extent, is why the market got priced down to a relatively low multiple and now is an exceptionally low multiple with this contagion from the US and Europe.
Talk about hard landing, that's not likely to happen at all?
I think China has a very good track record in terms of policy, and we've had a period of monetary tightening now that should also bring inflation under control. And money growth is basically where it was at the back end of 08, M2 growth of about 14.7%. So I think it's finished a monetary cycle, and the economy is slowing right now. But that sets us up, for the next cycle. And in particular, I think the market will start to discount 2012 as a pretty reasonable growth year. And again, like the rest of Asia and EM, exceptional relative growth to the situation in US and Europe.
You said earlier you like Chinese banks. What else do you like in China?
We're pretty keen on the energy sector. That's another key overweight, and we have some selective exposure to telecoms. We're still a little cautious about the outright consumer discretionary and real estate plays, but less nervous than we were at the start of the year.
If there is one sector you'll stay completely away from, would that be property?
No, it wouldn't be really. I think the sector really to be getting out of here is the ultra-defensive sectors across Asia and EM, which is consumer staples, healthcare, utilities. Those sectors have been holding up in this environment, and it's now time, I think, to be brave and get back into the market by moving out of some of these defensive areas.
Why is Korea the same story as China? You're liking Korea in a huge way right now. They're looking very cheap in terms of valuations.
Well, Korea's a secular ROE improvement story over the cycle. That's a key theme for Korea, particularly in the export-oriented industries. And yet, because it's a large and liquid market, when we get these global sell-offs, it sells off with a strong beta effect. So that's taken the multiple down to about 7.5 forward PE, which is even cheaper than at the low point of the 08-09 crisis. And that's way too cheap for the high-quality companies in Korea.
If it's so obvious, why are investors staying away from Korea then? I mean, what's the reservation there?
Well, the Korean market stabilized recently, but it has a lot to do with positioning, including on the retail side in the Korean market itself. And as I mentioned, the liquidity of the market in a global context, when there has been a huge period of outflows in this month of August. We've seen about $15 billion of outflows from dedicated Asia and EM equity funds in the last 3 weeks, triggered by the events in the US and Europe. But that doesn't actually have that much to do with fundamentals on the ground here, and particularly given the fact that an economy like Korea is increasingly oriented to intra-Asian trade as much as to US and Europe.
We're hearing, in fact, that the Trade Minister of Japan, Kaida, is offering his resignation to the Prime Minister, is also going to be moving on. So it will be a sixth Prime Minister in 5 years. I won't go into politics with an equity strategist, but I will ask, if I can, Japan as an investment opportunity.
Well, we're quite cautious structurally on the situation in Japan. I was mentioning in our previous break around Korea and its structural improvement in ROE, and unfortunately Japan is not showing that. It's been locked at the lowest ROE that we see in the Asian region for a good part of 10 to 15 years now. There are some world-class companies, but the strength of the yen is holding that Japan profitability back at the moment. And I think that's something that really needs to be addressed by any incoming Japanese administration.
So pockets of opportunity limited.
Yes, and indeed on the domestic side of the economy, it is far more similarities with Europe, for example, than the rest of Asia.
Fair to say then that it makes no difference who comes into power as the next Prime Minister. Policies will remain intact.
Well, we really want to see a more of an easing stance, particularly from the BOJ. And on the fiscal side, obviously Japan has a very large accumulated government debt to GDP ratio, which constrains them somewhat. But it would be good to see more easing of policy and certainly more weakness of the yen.
Seems no matter what the government does there, what the Ministry of Finance does, the yen goes the way it wants to go. We've been covering this all week. It'll be interesting to see what this latest move by the government, this $100 billion aid to industry, if it will actually make a difference.
Well, I think it clearly will help at the margin. Obviously, the yen is not unique in being very strong at the moment. The Swiss are having to cope also with the kind of effect of the move down that we're getting in the dollar, and the debate we were just having earlier about whether or not we're going to see QE3. So it's the US that's being most aggressive in terms of monetary policy.
Could that be the new normal, a strong yen, live with it?
Well, some companies in Japan can live with it and are the exception to the rule that ROE is relatively low. But again, thinking about some of these cross rates, so one of the things that Korea has managed to achieve is a relatively competitive 1 yen rate. It's not the only reason why Korean ROE is improving so much relative to Japan, but it is an important part of it.
We've covered the quantitative easing conversation about Ben Bernanke. You're saying it's going to be a non-event, more or less.
That would be our core view, but it's still possible we could be surprised on that.
What's the best case scenario? We need to know, what does the market want? Something, maybe
Direction.
An indication perhaps from Bernanke that he is willing to use all the options when needed.
As I mentioned earlier, the Fed's already taken a very big step, which is to pre-commit effectively to zero rates to the middle of 2013. That's a big step, and it produced some dissent within the Fed board itself. The data is still somewhat mixed. The sentiment surveys...
Was it the wrong step to do that, to be so bold 2 years ahead?
Well, we'll see how the data pans out. Obviously, some members of the Fed board felt that the data was not sufficiently bad to warrant it, and clearly inflation's much higher than this time a year ago. The data's very mixed. On the consumer sentiment side, it's pretty horrendous, but actually on the production side of the economy, it's not really clearly signaling recession.
The markets seem to be calling on the Fed to do something, and we keep talking about QE3, whether Ben Bernanke delivers on that or not. It remains to be seen, but I think what's interesting is the inflationary impact to Asia. If Ben Bernanke comes out and gives the market what it wants, Asia bears the brunt in some respects.
Yeah, I noticed you've been saying that on your shows. I've been sitting here. We wouldn't actually agree with that. A lot of the Asian inflation was generated effectively here through the strength of demand and through the easing that Asia did, particularly on China's side. Remember that the combined easing that China did probably generated over $3 trillion of new bank credit, which is larger than QE1 and QE2 combined over an 18-month period. And in fact, when you look at the global economy more generally, the bigger picture story is the strength of Asia's domestic demand and the fact that since really this whole story began of developed market problems in 2007, Asia and EM has been the only game in town from a growth perspective. So I don't think actually QE3, even if it happens to be that important for Asian inflation.
And I was listening earlier to your interview. You said now's the time to take some risks. You would be putting risk back on the table?
Yeah, I think one of the reasons the global economy has slowed is that Asia and EM itself was tightening from the end of last year until now. But that Asian tightening is likely to come to an end, and that's probably much more important than a new Fed program. We now are forecasting that we won't basically see more rate hikes in Asia through the end of the year, and we may incrementally start to see some easing. And remember who's the locomotive of the global economy now? It is Asia and EM, so their monetary policy is at least as important as what's going on in the United States. Mm-hmm. It's not a US-centric world anymore.
I often hear about Zeb's stories about China's consumers coming over here with bags of cash, and when he goes shopping, Zeb to buy his Prada shoes, etc. You've actually wrote a book 6 years ago, I think, called The Rise of the Chinese Consumer. Which interests me because they really are. I mean, Zeb's stories are really quite interesting about bags of cash coming in. I've seen a couple of stories myself. I mean,
well,
it just keeps rising.
At the time I wrote that book, China's autos market was 2 million units, and the US was 16 million, and China was about 15% of the PC shipments of the US. It's now bigger than the US in PCs and in autos. In fact, in most consumer product categories, China is the largest market. As I mentioned, intra-Asian trade is a big driver of growth here. The US isn't the centre of the whole system anymore, at least not economically. Financially, it's still very important, but economically, Asia's own growth is the central story.
But surely there'll be some spillover effects. The problems we're seeing in the US, in Europe, it will be felt in Asia, including China.
Well, as a financial markets phenomenon, that's why we're having very large fund outflows and portfolio liquidation and a kind of temporary beta trade. But just as in early 2009, the first part of the world to recover economically was Asia and EM, and Asian EM markets had their best year ever in equities in 2009, the fundamental story will reassert itself, and that's effectively the call we're making.
Have to come back to Korean equities. Every day this week we've been talking about the value that investors are seeing right now in South Korea, and I know you mentioned it earlier. Is it extremely appealing?
Yes, it is. It's one of really three markets you'd highlight, Korea, China and Brazil, which have exceptional value across Asia and EM. They're relatively large and liquid markets and they're big index constituents. And so in this sort of beta storm we've been going through, they've been driven down. But we think this is a great time to accumulate. On the 6 to 12 months view, it's probably one of the best opportunities we've seen in the last 15 to 20 years.